Oh my gosh, he hit the broadcast button early. Ah, I hate it when he does that. Oh my gosh. Jill, are you nervous about today? Is this your first webinar ever?
This is my first.
Oh, I'm sure you'll be at least good. The audience has a very low standard though, so I wouldn't worry about it. Peter, is this your second webinar?
I think so.
All right. Well, just remember that you're probably not doing as well as you think you are during the webinar. That's good advice. All right, ladies and gentlemen, children of all ages, welcome to this webinar. I'm going to scram, and up comes the man. Hello, I'm Alan Gassman, and I am here with the Dream Team to talk about the new tax provisions update. When President Biden signed the debt ceiling increase, a lot of people didn't realize that there was substantive tax law changes there, and an overwhelmingly bipartisan vote and very little friction that I heard about to get these tax law changes made. So we are here with Jill Ashley, who is in her third career. Her first career was a CPA, her second career a financial advisor. Now she's working on her third career, which is as a webcast moderator. And then Peter Farrell, who's going to graduate law school in May and then go get an LLM in taxation and then settle in Sanford, Florida. And then my partner, Brandon Ketron, who everyone knows does all the heavy lifting in our firm. And this is a free webinar. That's why it's not very good. It does not qualify for continuing education credits. And in about 3 to 5 hours, you will get an email and you can open it safely and it will allow you to watch this webinar or forward it to your friends to watch this webinar as many times as you like. If you have a question, just click on the inverted pyramid there and then type in your question. And if we know the answer, we'll answer it. And if we don't, we'll pretend not to see it. Go to our YouTube channel later on, and this will be displayed proudly with many of our other videos. And we let Peter open up here with a discussion of my favorite part of this new law, and that is the ability to do a one-time transfer for people over 70 and a half to satisfy their minimum distribution requirement and to transfer $50,000 directly from their IRA to a charitable remainder trust, which we will cheerfully draft for you, or a charitable gift annuity, which your favorite charity will cheerfully put together for you. And Peter, I just explained the whole thing, but is there anything to add?
Well, I will say we wrote an article about this on Friday. There's a link in the slides if you want to learn more about those different types of split interest entities and charitable gift annuities. We go into a lot of detail there that might be outside of our discussion tonight. Yeah, this is a helpful chart if you're looking at the additional rules for these three that the Act imposes if you're going to do this. A couple of them that are interesting is that you'll see here, no person can hold an income interest in the CRAT other than the individual for whose benefit such account is maintained or his or her spouse, and that the income interest in the CRAT is non-assignable. So one of the questions we've been discussing is whether this can be a term of years. Because if it's a term of years, then your children or someone else might have an interest in the property after you die, and that might make it not meet these requirements. And we're not really sure yet.
Okay, let me back up just a little bit because we have a lot of people on this webinar who are not tax professionals. They're very lucky, by the way. So in the charitable remainder world, there's something called a charitable remainder trust, and I can put money or appreciated assets into a charitable remainder trust and get an income tax deduction for funding the trust, and then I get payments over a period of years or over my lifetime. And then when I die, what's left goes to a charity, and I can designate the charity and change the charity anytime I want during my lifetime. So what Congress had said here is saying here is, instead of putting your own money or your after-tax money or other assets into a charitable remainder trust, you could form a charitable remainder trust that pays you an income for your life or for the life of you and your spouse, move up to $50,000 of IRA money into it, and pay no income tax on the $50,000 of IRA money, but you do pay income tax later on as you get your payments. So $50,000 times 37%, $18,500, a high bracket payer or somebody who lives in a state where they have income taxes will defer more than that. And you can set the payments on the charitable remainder trust so that 90% of the expected value is coming back to you, your client, and only 10% is going to the charity. So especially for retirees who are just 71, 72 and have higher income than they expect to have later, this will have a good impact, not only deferring the income tax, but reducing some of the income tax. What is not known, as Peter alluded to, is that the law says that the income interest has to be solely for the IRA owner and his or her spouse. But there is a charitable remainder trust that isn't a life interest, it's a 20-year interest. Or you can do a charitable remainder trust where it's for the longer of your lifetime or up to 20 years. So Brandon, if Marcia and I do this, and we choose the longer of our lives are 20 years, and then we fall off the seawall and pass away, and then our daughter would inherit what's left of the 20 years, does that disqualify it?
Yeah, I mean, just looking at the text of the rule, it's possible that it does. I don't know if that's what they've intended to do here, but yeah, I think that could be a potential issue because it has to be based upon the way it reads, based upon your life or your spouse's life. Now, one thing that you might be able to do without running afoul of those is the shorter of your life or 10 years. So that way, you have 10 years deferral where you get it all back within 10 years if you outlive that term. But I'm not sure that you could do the longer of or simply a term of years because of that issue with who benefits after the death of you and your spouse.
Yeah, so this pretty new law has a gaping hole in it, and hopefully we'll get a technical correction. So there's two types of charitable remainder trust. There's the charitable remainder annuity trust, which pays a fixed dollar amount every year. And then there's a charitable remainder unit trust, which pays a percentage of the value every year. And usually a charitable remainder unit trust works better if values are going up. So Peter, how would you explain a charitable gift annuity to somebody who's fortunate enough not to be a tax professional?
Well, as it says here, a charity will receive a donation of cash and other assets, and then will agree to make an annual payment to the donor. It says usually for a fixed annual amount for the donor's lifetime, or it can be a value of the stream of payments. The value of the stream of payments is typically 1/2 of the value of the total amount transferred to the charity. And then the donor will receive an income tax deduction of approximately 1/2 of the value of his or her donation, and then receive that stream of payments. They're partly taxable and partly considered to be a return of the principal.
So in this case, I'll give the 50,000 or less to the charity, and I won't pay any tax on what comes out of the IRA. The charity will get the 50,000. The charity won't pay any tax, and then the charity will agree to pay me or me and Marcia for our joint lifetime a certain dollar amount a year, and we'll pay ordinary income tax as we get the payment, but it will be deferred. And usually the rule of thumb in the industry is that they'll give us back an annuity that costs about half of what we gave them, and the other half will be charitable. So Brandon, I didn't see in this statute that it mentioned taking a charitable income tax deduction. I think they assume there is no charitable income tax deduction. And,
Right.
and I guess that's what the qualified distribution rules say, but it's just not in the part of the legislation that was just added.
Yeah, what the rules say is they actually treat the remainder that's supposed to pass to charity, which if you max it out would be around 10% of what you contribute. So, let's say you put $50,000 in, you get $5,000 a year back, which is equal to, $45,000 as far as that stream of income back to you. So the remainder would be equal to $5,000. If you set this up outside of the IRA, typically you would receive a $5,000 income tax deduction. But here, what they've instead said is that $5,000 is treated as a qualified charitable distribution, to where you don't have to pay income tax on that $5,000 that's passing to charity. So you get the equivalent of your income tax deduction by treating that as a distribution to the charity. So then only what comes back to you is taxable. So you don't get a separate income tax deduction. It counts as a qualified charitable distribution, which I guess that's another point. If you're over the age of 70 and a half, you can take what would be your requirement of distribution and send up to $100,000 of that each year directly to a charity from your IRA to satisfy your requirement of distribution. So you don't pay any income tax on that, but you don't get a charitable deduction because you get the benefit of not paying tax on what goes to the charity. If you do this charitable remainder trust, that $5,000 remainder interest, however that's calculated, is going to reduce what you could otherwise send to charity with the qualified charitable distribution. So instead of having a full $100,000, now you would only have $95,000 to use towards the remainder of that qualified charitable distribution.
Now, I'm going to tell you, there are already skeptics out there, and they're saying this won't work because it'll be so expensive to set up a charitable remainder trust, so expensive to put an investment in it, and so expensive to file an income tax return every year for the charitable remainder trust. I will take the opposite position and say that I think that's poppycock. If you use a scaled down IRS approved form, if you just fund it with one balanced fund, an inexpensive balanced mutual fund, and you get H&R Block to fill out that form, it should not be that expensive. It seems to me you can pay the expenses from the charitable remainder trust itself. So in effect, it's kind of like tax deductible. It converts investment expenses that are not deductible to being tax deductible. And then the same donor, as long as they've gone through this process, can do another charitable remainder trust with appreciated stock and get a real tax benefit. And then they can just run two charitable remainder trusts separately, or they can decide to go with the charitable gift annuity. But I think that this is going to be a great door opener and a great loss leader, or whatever you would call it, for the charitable industry. And I think it will result in a lot of people happily deferring $18,500 or more of income tax.
Yeah.
Jill, anything from your standpoint as an investment advisor?
I have to unmute myself. No, I think you made a good point. The expense is probably a barrier for a lot of people, but as you said, you can do it in a simplified manner. And whether, even if it's in the S&P 500, if it's going to be in there long enough, I just think it's probably worth it. But if anyone is worried about the expense, going to a charity that sets up the gift annuity and handles all those expenses themselves, that's just an easy fix.
Okay.
Alan, I think you made a really good point that a really good candidate for this would be someone that is still working in their high earning years at 70, 71, 72, and you do this charitable remainder trust to defer those distributions to when they might be, 76, 77 and have retired, and their income tax bracket might drop from 37% to 24%. So not only do you get the deferral, but you get a 13% reduction in their income tax rate, which even adds to the benefits here.
Right. Right. I also like the fact that it's indexed with inflation. So Jill, what's going on with the minimum distribution rules?
So for people that were born in 1950 and later, there's actually no change because they already started taking their required minimum distributions at 72. But for this year, for the next 9 years until 2032, the RMD age has changed and it will go up to 73. So you can defer until age 73. And that's for account owners that are born in 1951 and later. And then in 10 years from now, in 2033, the RMD age begins at 75. So that's for account owners age 59 and later.
That's a really generous provision, enacted by, I think, every Democrat in the Senate and the House. So that was a nice give me for the wealthy, and it also simplifies your life until you're 75. Now you don't have to worry about these silly minimum distribution rules. So what do we see here on page 16, Jill?
So this shows the modified, adjusted gross income limits for contributing to IRAs, because there's a lot of different IRA categories, whether there's income limitations for whether you're single, you're married, whether a spouse participates in a plan at work, whether you participate. So really that table says it all, rather than reading it all out, it shows the different income limits for your modified adjusted gross income, when you can take a full, depending on your category, a full deduction for an IRA, when it starts to get phased out, and then when it maxes out in each one of those categories.
Okay, great. And then Jill, do you just want to talk for half a minute about the indexing of Section 179 expenses? I think that's another just great provision.
Sure. So businesses do have a lot of advantages here. Section 179 has been around for years, so it's nothing new, but what's new are the inflation adjusted amounts. So for 2023, a business can elect, it is an election, which I can come back to that in a minute, but you can elect to deduct up to 100% of the cost of qualifying property, which would include furniture, fixtures, equipment, and most off-the-shelf software, up to $1,080,000 in 2022. So for this current year, it's $1,160,000. The reason why you might not want to elect that is, or it's not an all or nothing. You can elect partial amount up to the amount of profit you have in the business, and up to the maximum cost here on how much you've actually invested. I think it's up to $2.7 million in 2022, and your total cost of all equipment, $2.89 million in 2023. But if you have a loss, you don't want to take it, or if you just want to reduce your business taxable income to zero, you can take elect a partial deduction and allow the rest of it to be depreciated over time, over its useful life. And then if you do have an income limitation and you did take more than you can use in 1 year, you can carry that over to future years where it might be more beneficial.
Okay, very good. Brandon, anything you want to mention on page 19?
Yeah, I think these are the hardest part of this statute going through is all the different effective dates. All these things, some apply this year, some apply next year in 24, others don't apply until 4 or 5 years from now. So I think this comes from maybe the Senate Finance Committee report as to a chart really of when these effective dates apply. So as you're going through these, you'll notice different effective dates throughout, and this chart just really summarizes it nicely, so you can kind of keep track of those things.
I think Peter created this chart, right, Peter? I don't think the Senate did.
No, I created the chart. We used the Senate's summaries of the legislation, but.
Yeah, well, I mean, it's an excellent chart and does a nice job of laying things out.
Even though you know Peter did it, you still think it's an excellent chart?
Now that Peter did it, it's an even better chart than what I thought the Senate Finance Committee did.
There's
I mean, Gassman original, Gassman, Crotty, and Denicolo original.
yeah, but what's really neat about these laws is they don't take effect until 2024, 2025. It actually gives us time to get ready for them, and it gives lobbyists time to work on Congress to not change them again. So it was very interesting how that came out. So we have a lot of these summarized, but we're not going to be able to get to them today. But the changes in the required minimum distribution rules here on page 32, Jill already covered. And then Jill gave us a great chart here on page 33 on the catch-ups, how the catch-up is going to be more generous now. You'll be able to put more into IRAs, and then they're going to index this for inflation, which is very nice. And then this is really cool. If you have an employee who can't really afford the 401k match and they're making student loan payments, then you'll have to match the 401k as if they did the matched contribution based on their student loans. So I thought that was a very creative way for rewarding people for paying their student loans and allowing employers to do that on a tax deductible basis. That's not until 2024. There will be a lot of retirement plan amendments going on between now and then. And then there is an emergency expense withdrawal provision that allows an employer to give an employee up to $1,000 as long as the employee says they had an emergency. And $1,000 is not a whole lot of money, but like, let's say the employee has a sick goldfish, okay? They go to the vet, it's like $450 to get a blood test for the goldfish, and then the goldfish needs therapy. So they'll be able to get $1,000 out of the plan. Otherwise, if you're going to have an emergency, probably do it not in the United States, but in a less expensive country. That was Peter's idea. All right, Brandon, I'm up to you on page 50.
Yeah, so this is another change to the ABLE plans, which essentially is a way to put money away tax-free for disabled individuals and use that account for their support. It operates similar to a 529 plan, if you're familiar with those, where the money grows tax-free as long as you use it for education. You don't pay income tax on that amount. Well, same thing here. If you put money in an ABLE account and use it for disability expenses for the qualified individual, then you don't pay tax on those amounts either. The problem with this is that the individual had to be disabled prior to the age of 26 under current law. So, if you're in an accident and have, some sort of disability occurs afterwards and you were 30 years old, then you didn't get to take advantage of this program. Well, now, fortunately, under this new act, they've increased the age to 46. So a lot more people will be eligible moving forward for these types of plans. Nothing else really changed with the plans, but other than increasing the age, which I thought was a nice change to make this available for a lot more people.
Yeah, I'm glad they're able to use it. Okay. This is the why you should terminate your part-time workers law.
Yeah, so they just added a little bit of rules here on the change to, you're now required to include part-time workers in your 401k plan under certain rules. It went from a 3-year service requirement down to a 2-year service requirement. So, if there might be some changes to what you're required to cover for part-time workers. The nice benefit here is it doesn't apply until 2025. So those plans have a lot of time to send out notices to everyone and figure out what the rules really are with respect to this. But just be aware, this is going to come into effect in 2025, which may, change some of your thinking with respect to part-time workers.
Right. The pension plan laws have always said you could cover them at 500 hours, but have allowed you to use 1,000 hours. So I guess the 1,000-hour safe harbor is almost gone here. So this is really, I agree with Brandon. This is a very interesting change here on page 52 that Jill's going to cover. So you have a 529 plan that you set up for this child, and now it's more than 15 years old. and the child is not going to use it for whatever reason, you could put it into the child's Roth IRA, and then it can grow tax-free for the child's entire lifetime. Jill, can this be true? I'm pinching myself.
Yes, it's a nice strategy that the Secure 2.0 Act opened up for a lot of taxpayers. So there's a couple of caveats though. You can transfer up to $35,000 of unused 529 funds into a Roth IRA in the name of the account owner on the 529. That can be the child that didn't use it all or didn't use any of it, or it can be the parent or grandparent or whoever originally contributed the money to the 529 plan. They can change the beneficiary to themselves and then roll it into a Roth IRA for themselves. The caveat is it's $35,000 maximum over a lifetime, but it's limited to the increments of the annual Roth IRA contribution limits. So at the bottom of the chart, you can see for this year, it's $6,500 a year that you can actually do that rollover. And it's got to be a direct trustee to trustee transfer. You don't want to just, get a withdrawal and then redeposit it into an IRA. The 529 plans have to have been in place for that child for 15 years before you can do this kind of transaction. Generally, they're set up when a child is young and a grandparent or a parent has funded that over time. But then whenever those Roth IRA distributions are available, you have to hold that in the Roth IRA for 5 years before you can make a distribution to avoid any kind of penalties. It's a neat.
This is going to drive financial advisors crazy, having to coordinate all this, explain it. And then when you take money out of a 529 plan, the income comes out pro rata to principal. It's not like worst first. Is there any mention in this law as to whether that carries income out into the Roth IRA, or does the income from the rest of the 529 plan cook in there? Do you know?
So the amount that transfers to the Roth, as long as it stays in there 5 years before any distributions from that Roth, will be tax-free, if that answers your question.
Okay.
Yeah, but I think if you take it out within the 5, then you do have the pro rata allocation of whatever built-in income was in the 529 plan.
Yes.
Okay. So the planning point here is drop out of school, convert to the Roth, and then you can put it in Bitcoin, because you can't invest with Bitcoin in 529 plans. So we hope that this helps a lot of people. All right. Finally, another very interesting change as we see the business industry affect the tax law is the Qualified Longevity Annuity Contract, the CLAC. Brandon, are you going to cover this?
Yeah, I'll cover this one. So the QLACs came about, I think 2014-ish was when they were originally introduced. And what they did was say, in lieu of taking, your requirement of distributions, you can put a certain amount into this annuity contract where we'll pay you X amount of money for the rest of your life. It can be an immediate annuity or it can be deferred all the way up until the age of 85. So I think the old rules said 125,000 or 25% of your IRA balance, whichever is lesser, can be put into these types of contracts. And the idea was, if you live a long time, you're always going to have that annuity paying to you. And then it also was a nice tax planning idea because, again, any type of time you can defer distributions from the retirement plan generally allows it to grow and come back out at a higher rate of return to the individual. So the problem with that was this 25% limit. It just limited a lot of people to be able to do this, because if you had a low IRA balance, then you couldn't really put a lot into the QLAC. So what the new law says is not only are we going to remove the 25% limit, but we're going to allow up to $200,000 to go into these types of plans. It's going to be indexed for inflation. So now if you are an IRA owner and you're getting ready to have requirement distribution start at age 72, you can take $200,000 of your plan, stick it over into this qualified longevity annuity contract that would defer distributions until you turn 84, for example, and then start paying you an annuity at age 84 for the rest of your life. So there's a lot of financial analysis involved in that as to whether that's beneficial or you should just take out the requirement of distributions. But certainly if you have a long life expectancy, you're healthy, and you want to, kind of hedge against, living long and running out of money, these types of plans work out really well. So I won't get into the financial analysis, but that's something you can discuss with your advisors as to whether or not it's worthwhile or not. But a nice change to make these, I think, available for a lot more people now with this new limits, or I guess the repeal of the limits, and increasing the amount that can go in.
Yes, it'll probably take quite a few months for the life insurance industry to gear up to offer these. I think I saw somewhere in here that they're going to allow what is called indexed annuities in here, which I think was not allowed before. These can pay some pretty big commissions to investment advisors who may be quite interested in getting their hands on $200,000 of your client's IRA monies. So I would reach out to the clients. We will reach out to the clients and ask them to proceed very carefully before they use this exception to make sure that what's done is done properly and conservatively. Okay, so we are done with our promised 30 minutes here. Is there anything else that we wanted to make sure to cover? Or Brandon, do you want to fly through some of these?
Yeah, I'll flip through quick. I think this is a really important one, which can impact a lot of people, is if you fail to take a requirement of distribution, historically that penalty has been 50% of what was required to be distributed, plus potentially subject to excise tax. But the new rules drop that down to 25%, and then provide an even better benefit to where if you do this in a timely manner under certain defined parts of the act, basically before the IRS catches you is what it really says. So if you do it voluntarily, the penalty is only going to be 10%. So if you missed a requirement of distribution or you have that hanging over your head, now would be the time to correct that, subject to these reduced penalties amounts, which can be as low as 10%. Historically, the IRS has always been pretty lenient about giving waivers for these penalties as well. We'll see how that applies moving forward now that they have these reduced amounts, so it's not quite as penal. So they may not be as friendly about giving the waivers, so that's another consideration. But I thought this was a nice change to kind of relax those stiff penalties. We talked about the split interest and the ability to give to a charitable arranger trust or a charitable gift annuity, so I'll skip that one. One other one here is when you have an IRA that engages in a prohibited transaction. So a lot of people have these self-directed IRAs where the account owner can really direct how the assets are invested and what they're used for. Some people use them to invest in real estate, some might invest into a business. But the problem with that is if you have, as an individual, and you provide any benefit at all to that IRA, if you have a house and you go and change the plumbing in the house or fix the sink or paint a wall, you've now engaged in a prohibited transaction. And that disqualifies not only that portion of the IRA that's invested into the real estate, but the entire IRA. So these were very penal, and you had to really watch out for this. What these new rules say is that now we can segregate out that investment into a separate account or to a separate IRA, and then only have the portion that was invested, that was separated out, deemed to be disqualified if you engage in a prohibited transaction. So it's not going to disqualify the entire IRA like it did in the past. So a lot more utility here, a lot less risk involved for these self-directed IRAs, and I thought that was a nice change to liberalize those rules. One other exception to the 10% excise tax, where if you are not 59 and you take money out of your IRA, you have to pay a 10% tax on that. Now they've said if you are terminally ill, which means you're expected to die within 84 months, that's designated by a physician, you can go ahead and start pulling money out of your IRA, not subject to that excise tax. So ability to pay for health care and other expenses if you are terminally ill without being subject to the excise tax. I'm not sure. One other point here, if you have a special needs trust that's receiving an IRA, historically that had to always be for the benefit of the special needs beneficiary, could not benefit anyone else. They came up with a new rule under the Secure 2.0 that says you can have a charity as the remainder beneficiary of that special needs trust for the benefit of the special needs individual, and that's not going to disqualify you from distributing out the IRA over the life expectancy of the special needs beneficiary. So that's a nice exception. That doesn't apply anywhere else in the code, only for special needs beneficiaries. You can have a charity as a remainder to that trust and not disqualify the life expectancy payouts. See if we have any more to hit on here. I think this is the last one. They are getting strict on charitable or conservation easements. So this has been around for a while. There's been regs passed on conservation easements. There's been statutes, and the IRS has these as a listed transaction for potential abusive tax avoidance. So be really, really careful when you are engaging in these types of plans and making sure all your I's are dotted, T's are crossed, because the IRS are looking hard at these. What this new law says is that we're going to limit your deduction to 2.5 times of your basis in the partnership. So the days of getting, contributing small amounts to partnerships and getting a massive charitable deduction are over. It's going to be subject to some sort of limitation, 2.5 times your basis generally. Holding requirements as well are going to be a part of this. So these are all new rules. If you're in this arena or have one of these or thinking about one of these, make sure that these are addressed, and therefore you're not going to be subject to any of these abuse rules. And I think that's all we have, Alan, if you want to close us out.
Well, I'm going to close you out by telling you that Kathy McHenry of the Evangelical Lutheran Church of America has let us know that they will pay 100% of the cost of a charitable remainder trust that receives a $50,000 IRA contribution. And I don't think that this is the only charity that's going to go ahead and make that mechanism available. Because look, by law, you have to expect that 10% of the remainder will go to the charity. That's $5,000. But more than that, it enables the charity to interact with somebody who is more likely than not to donate more. So I appreciate receiving that feedback. We're going to be presenting this as a 90-minute talk for Lineberg Information Services, but that's not so free. If you're interested in it, let us know, and we'll let you know. We are also looking for beta readers for our book on charitable giving for tax and charitable advisors. If you're interested in taking a look at the beta version of that, please let us know. We have put that into a 501c3 organization that we formed called the National Institute for Charitable Education. We thought that was a nice name, and now law students will be able to get their pro bono hours contributing to that book and other charitable writings. If you have questions, please let us know. In 2 or 3 hours, you'll be getting a playback of this video. You could play it in the hot tub with your significant other tonight and go through the slides. You could laminate the slides if you have time. Enjoy a glass of wine and have a great, wonderful evening. Special thanks to Jill and to Peter and to our other law clerk, the other Brandon, for all the work you did on this today. You did a fantastic job. I learned a lot, and thanks again.